For those of you that don't know me, I founded Dope CFO, built upon mostly all of my work papers and tools, et cetera, that I've built over, actually, some of them more than 10 years ago, but most of the cannabis stuff over the last 5 years. I'm speaking around the US. I helped plan and lead the November AICPA conference last year. I'm right now planning and will lead the August Denver AICPA conference, which is coming up. That's going to be a lot of fun as well as many other conferences this year. So we have lots of problems with inventory. First off, is just the fact that for a lot of the niches, we actually need cost accounting to even figure out what the heck inventory is. I mean, what's the cost to grow a pound of weed out in the garden? You can't know that answer without doing cost accounting. I would still suggest today, out of the 100,000 cannabis, really 150,000 cannabis CBD companies, probably 8 out of 10 easily are not doing cost accounting. So that means their inventory is flat out wrong for accrual accounting or 471 and tax. We also have, software, lots of pieces of software. So you've got, every state has seed to sale, which is going to be Metric, MJ Freeway, or BioTrack. They're all crappy, but you're forced upon it. Then you're going to have an accounting system, which could be QBO or Accounting Suite or Xero or whatever the heck it is. And then you'll have a POS system at the dispensary, which could be one of 100 POS systems. These systems are all mostly new. They don't work great. So we got to do lots of reconciling as well. We're still seeing today many companies that just refuse to count inventory, which is a bad idea. When the IRS shows up, they're going to be in a bad situation, not understanding seed to sale process or the different verticals as well. Okay, let's jump into by the way, if you have any questions, type it into chat down here. And those of you, again, in the program already, this will just be some review for all of you all. 280E, I like to bring this up over and over and over because I've now studied it for so long, and I've whether it's on my podcast interviewing cannabis attorneys that are dealing with the IRS daily, or being at AICPA meetings and conventions, I've just had a lot of exposure to this, and with pretty much all the key experts in the cannabis, both attorney and accounting. So this is where it says no deduction or credit is going to be allowed if you're trafficking a controlled substance. So this is where I think cannabis will come off, hopefully this year. So 280E could go away for cannabis, just like it did for CBD and hemp. Will this affect us? Not really. We'll still have to do GAAP cost accounting for all these niches. We'll still need tools and work papers and systems to do that correctly. Those clients will still need us. The big firms are coming in the space, and they are here now. But from my talking to many of the top people at these national firms, they're having a staffing issue as well. They're having trouble, keeping staff on their non-cannabis divisions, much less launching into the cannabis industry. And so they do have small divisions, but even when it's fully legal 10 years from now, most of those firms are focused on public filings, audit, attest, reviews, et cetera, public filings. So they'll still need us for all the day-to-day accounting, CFO work, tax planning, tax returns. So Schedule 1 says, this substance has no known medical benefits. That's one of the 2 or 3 components to be on Schedule 1. Well, that's obviously completely false. Even the government knows this because they have their own scientists at National Institute of Health and otherwise documenting. So we finally have science catching up to what people have known for hundreds, if not thousands of years. Cannabis has many, many, many medical benefits, hundreds maybe. So does CBD. and so does CBN and other chemicals. So if you go out 10 years from now, the big pharmas are coming. Pfizer just did a $6 billion acquisition. There will be many of our medicines that were prescribed as we're getting older, whether it's anxiety or sleep or pain or whatever. Our medicines will have THC in them. They will have CBD. They will have mixtures of these ingredients. It's just coming. Anyone who does not believe that is, it's like saying the sky is purple. It's just, there's nothing going to hold that back. But in the meantime, if your trade or business, that term is very broad. It doesn't say if you're a legal entity or if you're S Corp or maybe one of your multi-entity structures. It says is your trade or business. That's an incredibly broad definition. That can mean anything. It says if that trade or business is trafficking. Again, it doesn't say if your trade or business has a business that owns some pot and then sells it. It says, are you trafficking? What the heck is trafficking? Well, in the criminal world, if you are a delivery company, you're trafficking. In the state legal cannabis realm, are you trafficking? Maybe, maybe not. That hadn't been tested in the courts yet. So we'll see on that. Some dispensaries, which we're talking about, do delivery. Dispensary generally is going to be trafficking anyway because they own the pot. So 471 is our rule for inventories. We must follow this. So think about it. You're a cannabis company, a dispensary, a farm, whatever, or multi-integrated. If you don't have inventory, you flat out will get no deductions on your tax return. So just pretend you didn't utilize 471 and you didn't have inventory. You're not going to have cost of goods sold. And if you don't have cost of goods sold, we just saw right here, you can't deduct anything else and no credits. I get this question a lot. Well, what about the solar credit or the depreciation credit? It says right here, no credit. No means no. It doesn't mean some, it means none. So if you don't do inventory, your return, I say a third grader could do it because you just put your revenues on. Typical dispensary, let's say 5 million revenues. What are your deductions and credit? No cost of goods sold, zero taxable income, 5 million, pay your tax. Not a great solution for a lot of companies. So we want to utilize 471. Unfortunately for retailers and dispensaries right here, they have to use 471.3, which is the least good part of 471, the place where we can get more benefit, a lot more benefit, if we know how to do cost accounting, which again, most doing accounting in the industry have no idea how to do cost accounting, nor the tools to do it correctly. So they're not doing it anyway. As well, that's 471.11, but 471.3 basically says, you know, you're a dispensary. If you buy a pack of gummy bears from the gummy bear maker for $5, that is your cost of your inventory. You can't start piling in other costs like, well, what about rent for my dispensary or for the part where I display the gummy bears or this, that, and the other? You can't do it. You can add in a little bit of transportation and other necessary, but usually transportation is paid for by the farm or whatever. If you really, actually, I need to update this slide. If you actually change the nature of the product, and I'm going to cover this a little more later, change that nature of the product once it comes on site. So say someone brings you a pound of pot and you actually do some processing and you turn that pot into oil and then you make that oil into a gummy bear, that's production. And yes, you could use some of 471.11. This was an old example. If you just take flour and turn it into a pre-roll, that doesn't work anymore post Harborside. So that's an example of what not to do in a dispensary. So many dispensaries are figuring out pretty early on that, you know, at the very least, even before you consider tax, adding on a farming or processing can add more value to your company, make you more desirable as an acquisition target. So it makes sense already. Plus, if you can do some of that, if you have a big dispensary and you have a big facility in the back of it that's doing some real manufacture, you can end up getting more of that cost into inventory. And what happens to inventory when it's sold? It becomes cost of goods sold, and cost of goods sold under 471 is not a deduction or not a credit. That's why it qualifies as lowering taxable income. So on the tax return, you got to put revenues, you get to deduct cost of goods sold, and that's taxable income. And cost of goods sold is not a deduction. It's not a credit. It is a return of capital. And so so for that reason, pretty much everybody in cannabis wants to maximize inventory, because the bigger your inventory is, the bigger your cost of goods sold is going to be when that inventory is sold. So the best way to do that is to have some kind of processing or manufacturing. But if you're just purely a dispensary, you're going to have to stick with 471-3. And here is the actual 471.3. So if you were to go in and read 471.11, and you can do that afterwards, just Google IRC 471.11, you'll see that it's a very, very long tax code. It will take you a long time to read it, maybe an hour or two. But in 471.3, we can just read it here together. And really, we can't even read the whole thing. So down here in B, once we get to the but there in about the middle, that's where it stops, because 263A is not allowed for cannabis dispensaries, as Harborside learned as they went through all the court cases with them. So basically, this first sentence, in the case of merchandise, the invoice price less trade discounts, which probably aren't going to see any of that, all that's about discounts. So half of that, just delete all that, because there probably won't be any. So it's going to be the invoice price. You can add to that transportation or necessary charges incurred in acquiring possession. So I've had people in my group ask, wait a minute, what if we put a label on it? We stuck it in a bottle or made a joint on a pre-roll and put it in a box. That's not a cost in acquiring. That's a different cost. That would be a selling or distribution or whatever cost. But it says pretty clearly, here is your cost. So anytime your dispensary owner says, what can we add in? Just send them this 2 sentences. That's it. There you have it. And if you want to try to be aggressive and do more than that, and the IRS shows up, you could be in a very bad way. So now down here, in the case of merchandise produced by the taxpayer. So that's different than buying. So usually dispensaries are just buying stuff. When you talk about production, you're talking about, actually, that's where we're going to get into 471.11, which applies to manufacturing. Then you're going to get a look at raw materials, direct labor, indirect production, and we'll look at that, I think, real briefly in 471.11. But the simple fact is, 90% or more of dispensaries are not doing production. They're not doing any of this stuff. They're not going to, if they're not vertically integrated, 471.11 won't come into play, meaning they will be pretty limited on what their inventory cost is. Now, right here is where I've updated the slide. In the Harborside case, they said, well, what does that mean if the dispensary gets the raw flower and does something to it? Well, that something needs to be an essential change to the character of the merchandise. That's pretty, again, when I notice from now studying a lot of these cases, the courts like to be incredibly broad, and this is not good news for the dispensary owner. And so it's basically saying an essential change. So rolling a joint up is not going to be an essential change. Turning flour into oil, that would be an essential change to the character. So again, look at this if your clients are doing that. If they were able to manufacture and produce some things, then they would get into 471.11. And if they do that, then as long as they're doing this in their normal recurring financials, again, even we find this at the farmers, they're blowing 471.11 because they're doing it wrong. They're not doing it in their recurring financials. They're not doing cost accounting under full absorption cost accounting. And they're not doing full absorption cost accounting in accordance with GAAP, meaning they're losing a lot of their costs that they could be putting into inventory. We've got a separate webinar on that, so I'm not going to deep dive into that one. Now, here's another way that a dispensary could get some costs allocated. And the very, very first case, you go way back, the Champ case, in California, they actually had a real separate business of caregiving and things that were not selling pot. So if you have a division in your business that's not selling pot, so say you're selling T-shirts, you got to be careful, because lots of dispensaries will sell T-shirts with their their logo on the t-shirt, and then they'll sell coffee cups, and then they'll sell bongs, and they'll sell rolling papers, and all kind of paraphernalia. The courts have said, that's really not a different non-cannabis division. They almost look at those sales as supportive of the cannabis company as and or advertising costs, because if you're just selling t-shirts, with your logo on it, so you got to be careful on that. But if you have, I always use cookies as an example. They have a music line of business. They also have a massive clothing chain that is not just like, here, buy a cookies t-shirt. They have a real clothing line that does millions of dollars of business. And so that could qualify as a non-cannabis division. If you have a non-cannabis division, that division can deduct normal costs, which is good for the dispensary owner. So we want to make sure that if they think they have a non-cannabis division, make sure it actually works. Now people say, well, does this require a separate legal entity? No, it does not. You can have two divisions inside one LLC or one C Corp, and one can be cannabis and one can be non-cannabis. But you need to meet these criteria in bullet 3 here if you're going to do that. First off, the division must be profitable. It does not work, and many have tried this. Their cannabis division sells 10 million in sales. Their t-shirt division sells 100 grand. And then they think, but our t-shirts take up half the shop. So we're going to allocate half of our 5 million of costs over to the t-shirt division, and we're going to have a t-shirt division with a 4.9 million operating loss. Will not work. Stupid idea. Don't do it. Don't let your companies do it. So it's either needs to be showing a profit is the best solution, or really showing a profit at 10. Maybe it's going to be there not in year 1, but year 2. And there's not a huge loss, a small loss. So make sure, really, if you're going to go down this road, it's best to have a profitable division. It also needs to be substantial. If you have a dispensary like Harborside selling $100 million a pot, and your non-cannabis division's doing 700,000 or whatever, that is not substantial. They come in and look at this, all these entities and divisions from a high level. And if they look at this at a high level and they're like, wow, this looks like $100 million cannabis company, don't tell me you're selling, pencils on the side or whatever. That won't work either. And then finally, don't lump things together. You better account for it separately. So how do you do that if it's in one entity? Well, in QBO, for example, you could use class accounting. You could have one cannabis class, one non-cannabis class, and track it separately that way. POS systems will track canna and non-canna as well. And then you can prepare monthly financials for each division too, so that you can really show that we're treating these as two businesses. We're making management decisions on each business separately. You can do it that way. It is, if you really want to do it, I think it actually makes sense to separate it into two legal entities as well. Possibly, depending on entity structures, a whole nother ballgame, which we have webinars on that too. I'm not going to go into that as well. Court, again, is going to look at economic substance. They're looking, again, is your trade or business trafficking? So if they come in and look at the trade or business, they're like, look, this just looks like a cannabis company. You're wasting your time. And here's another point. It's hard for these dispensaries to come up with a non-cannabis division that makes a lot of money. And so if they're doing all this extra accounting and tricks and whatnot to do a non-cannabis division, and say it does 200 grand and it's actually profitable and we're accounting for it separately, and we get another 100 grand of cost in there, and that saves us 25 grand. Is that 25 grand on a $2 million tax bill even worth it? The headache of it? Maybe, maybe not. So be careful on those as well. If you're going to do it, make sure. So in our program, this is just a snippet of a pretty massive spreadsheet. We're going to have to go in there and look at labor and time percentages. We're going to have to do pretty detailed time tracking by employee from the owner on down. We're also going to have to look at square footages of the various stores, and see what percentage is canna, what percent is non-canna. We're going to allocate it one of two ways. The easy way is just to use a relative sales percentage to allocate the various costs. So if cannabis is is 96% and non-cannabis is 4%, we could just go down the P&L and put 4% to the non-cannabis division and then make sure it's still profitable. That's not really the best way. We're going to go in a more detail level into our trial balance and go kind of line by line and look, is this a cost related to labor or square footage or maybe even another allocation method? And then we will tie those things out from there. So if you're going to do this correctly, you're going to need some tools and spreadsheets. The people here from Dope CFO, you've got this spreadsheet already, so you'll be able to dive in deeper to that. Okay, so we've talked about some of the games that are being played. We talked about trafficking. We talked about that dispensaries are really limited on inventory. And then be aware at this point, and a lot of these games were plotted out early on in Colorado, Oregon, and Washington by attorneys like, oh, we can play this trick and here's a loophole here. At this point, the IRS is completely savvy to everything, including since all these cases have been through the courts. And so all these aren't really great tricks to do to cannabis companies. The biggest one I see still pitched everywhere is, oh, you just need to set up a ton of entities. So first off, think if I'm a dispensary owner in New York or wherever I'm going to do my new dispensary and I go talk to this attorney, my first thought is, what does this attorney have to gain by telling me to set up, 6 different C Corps and 8 different LLCs underneath that, and maybe a trust or 2, and who knows what else? Well, they're going to get a ton of legal work. And they're going to be able to say, this is the way to go. And you're going to spend 50 grand to set up all these entities. And then they're going to say, see you later. You've got your entity. Good luck. And then 4 years later, the auditors show up and they come in and they're like, I don't care that you've got 20 entities. We're looking at when we come here down to the corner and we walk in the building, it looks like a dispensary to us. I don't care how many entities are, they're all subject to 280E. And so what happens then? You're like, oh man, spent 50 grand on legal. I set up all these entities. I'm paying a fortune for accounting and tax because I got 20 different entities. And now I just learned that I just wasted my time and potentially even got double taxation by having some phantom income between those entities. So I'm kind of surprised that people are still doing this game. If there's a legitimate reason, yeah, maybe you have, for example, a legitimate reason for a dispensary, if the real estate is owned by the owner, to separate that into a non-cannabis entity. The reason for that is asset protection. So even if you see a Walgreens or a 7-Eleven on a street corner, oftentimes they don't own the real estate because it makes sense to put the real estate separately in case there's a lawsuit or something. So that would be one legitimate reason. That said, you're not going to be throwing a ton of costs over into that real estate entity to avoid 280E. That still won't work. The other one I used to see a lot more early on, especially in Oregon, and I don't myself do tax returns, but I know enough about tax, but I'd see the actual tax return, and it would be, they would put everything, literally every single thing into cost of goods sold. That does not work either. We talked about small non-cannabis divisions with high allocated losses. That won't work. When you go look at these court cases, the IRS is pretty much winning every single one, and they're winning a lot of money. And so I tell people, when I speak at events to cannabis owners, I say, look, if you're smart, you'll do 280E correctly. And that's a big word, correctly. Most are not doing it correctly, because then you can't actually minimize the tax correctly. How do you do it correctly? In my opinion, you go hire a Dope CFO VIP accountant. If you have someone who's not a Dope CFO VIP accountant, I would bet 90% they're not doing 280E correctly. So that's my recommendation to them. Then focus on what they actually do well, building their product and their brand, their market share, growing revenues, having a key location for their dispensaries is super important. Vertically integrate. The valuations will be based on those factors and not net income, because if you do it right, net income is going to be very low or potentially a net loss. You can still have a huge valuation, as we've seen in both the public and the private markets. So some of these court cases, we talked about Champ. These other ones were losses. And by the way, we've seen people go to jail. We've seen even much more litigation than this. We've seen things like OSHA coming in to farms in Oregon and hitting someone with a $600,000 fine because they're not following OSHA rules. So there's lots and lots of compliance. You need to think about OSHA or FDA or USDA or state rules or IRS audits. And including people losing licenses, which really makes investors unhappy, and or people can go to jail over these cases. Harborside, we talked about, they basically went through the courts forever, and actually, look how far back we're talking. 2007. This was only cleared up recently. They lost basically they're saying Harborside is one trader business. Didn't matter. They had a bunch of entities. And they couldn't use 47111. They actually got on this part, they had another issue. They were doing some production, but they didn't actually own it. They were taking in consignment flower and doing some stuff. You got to own, if you don't own the product, and you're just doing a consignment, 47111 isn't going to work either. This is a quote, page 37, if you want to go look it up. An activity is a trade or business if the taxpayer does it continuously and regularly with the intent of making a profit. Again, that is so incredibly broad. That doesn't leave room for little loopholes. So when the attorneys come in and say, yeah, you can do all these little loopholes to beat 280E, tell them to read page 37. And they also look at this, the degree of organizational, very broad word, economic, very broad word, interrelationship of various undertakings. Wow, what does that mean? Various undertakings. Very, very broad. The business purpose, which is a similarity of those undertakings. Anyway, end of the story. Harborside paid $11 million, but how much did they pay in legal fees over 10 years fighting this battle? Who knows? Millions, certainly. And what about time and headache? Who knows? What's the value of that? Okay, so how to make it all work? You've got to be doing a lot of things. So again, the simple solution, how to make it work. If you're not in our program, join Dope CFO, because you're going to need education, tools, systems, work papers, community, other experts. That's how to make it work. Long story short, but at the very least, we want to make sure you're doing month-end tie-outs, lots of reconciliations, all the balance sheet accounts, all the significant P&L accounts. We're doing lots and lots of inventory counts. At a dispensary, we're counting cash daily and reconciling it, inventory cycle counts every single week. We're going to be reconciling to the metric or state seed to sale reports. We use a flower calendar if there isn't any production going on involved. Also, our cost accounting work papers, non-cannabis work papers too. We need a cannabis tailored chart of accounts. We set up a perpetual data room for every client, as well as a permanent audit trail for every month for every client. That adds a huge amount of value to them. Why? First off, they can know their books or records are correct so that they can actually go out and have world-class reports to run their business and or improve cash flow. But they can also be set up for correctly minimizing tax. They can easier have access to capital, both debt and equity, as well as quicker exits. And by the way, we assume our clients are up for sale and up for exit from day one to day forever. There is a ton of M&A in this industry, if you haven't noticed, and there will be even massive more once the legal markets open up. So your clients have to be ready literally every second for both lending, equity, and sale. If you want to add value to them. This is just a snippet from a daily cash tie-out between the POS system and cash counts that are done, cycle counts through the day at the dispensary, and then multi-level supervisory tie-outs, and then also what they purchased or spent, and then we make sure if we have an AJE, if they're still off. Like in this example, they were off $2 on September 1st. Accounting solutions, many So there's lots and lots of ERPs coming into cannabis. They still have many, many issues. First and foremost, they cost a fortune. Secondly, we've seen implementations take more than a year. Nobody wants to do that. Training is very difficult. If you train Sally for 6 months in Nav 365 and she quits, you got to start over with someone else. Nobody knows how to work Nav 65 or whatever. Secondly, support is pretty weak and they're very buggy. So at the end of the day, what are we going to find in accounting? On the accounting side, when we just go grab a random dispensary or get a new client, it's going to be one of these three, and more than likely it's going to be a QB solution. So you better know how to deal with that side of that. POS, it's going to be no two clients will ever be the same. You're going to see one of 100. There are literally hundreds of these systems out there. Most of them are new and buggy. So don't trust them. I mean, I've found many dispensaries owners like, oh, we use Greenbits and it prints these beautiful reports and it's tracking everything, non-cannabis, cannabis, taxes, all this stuff. And they have these beautiful reports. It's like, oh, let me go over to the shelf here and count the 10 red gummy bears. And then I go to Greenbits and find out we've only got 8. And when I see right here on the shelf, we got 10 boxes, we would find many, many errors. And we have to simply do daily counts and tie outs to make sure they're. And this is where I built this sheet to show my dispensary owner who was using Greenbits and who thought everything was perfect until I showed him how many errors we found. And we kind of looked at this was just over here on the far left, what a mess this quickly becomes. It's like, look, we're just going to buy 10 pounds on day one, but we might have 3 different places where we can input that incorrectly just on the data entry side. So we may be inputting into Greenbits. We may be making an entry into our, in this case, accounting suite software. Then we got to go input this into Metric to make sure that's right. So already we could have made, if the person typing it in, who oftentimes is not an accountant at the dispensary, makes a mistake, we might be out of whack 5 minutes after we bought it. Then we're also going to be dealing with merchant services software, terminals where they're collecting money, cash in vault that we're counting. So we have all this over here on the red. And so I would show like, look, this is why we're doing so many counts of inventory and cash and reconciling merchant services down in these middle diamonds. And we're doing this daily and then a month in as well. And what I call the blue is the truth. I don't care what Metric says. I don't care what Greenbit says. I don't care what the accounting system says. If we go count, the boxes of gummy bears and there are only 10 and we can't find them anywhere else back in the warehouse or whatever, that's the answer. And we're going to have a journal entry.